The following podcast was recorded on Thursday, January 20th, 2022, featuring Sam Rines of Arbor Data Science. To hear the podcast in real time, you can sign up for a free trial at arborresearch.com or by emailing Gus Handler directly at gus.handler@arborresearch.com. You can also call Arbor Research and Trading at 1-800-606-1872. Thanks for your time and enjoy the podcast. Welcome everyone to the latest edition of Talking Data. I'm your host, Kristen Radosh of Arbor Research and Trading. Our commentator today is Sam Rines of Arbor Data Science. Welcome, Sam.
Thank you, Kristen.
You're welcome. Today, Sam will discuss sticky CPI, energy, and cracks in the manufacturing boom. So, Sam, consumers tend to have two things in mind when contemplating their outlook for inflation: groceries and gasoline. What can you tell us about flexible inflation?
So flexible inflation is the Fed's way, or one of the ways that they look at whether inflation is going to be persistent, whether it's in the system to stay, or whether it can come out of it. And when you look at this next slide here, it becomes pretty evident that a lot of the inflation that's currently in the system is what we would normally consider flexible inflation. That's food prices, highly volatile; gasoline prices, highly volatile; energy generally highly volatile. But you're beginning to see that sticky price begin to move a little bit higher. And that's partly because supply chains are disrupted, et cetera, et cetera. But a little bit of it is also that there's an idea that there's going to be a certain persistency within those energy and food complexes that will spill through to other things, right? If you're going to have higher transportation costs for a longer period of time, that's going to begin to flow through to real goods. That's going to begin to flow through to services, et cetera. So you're beginning to have that flexible CPI, that flexible inflation begin to become more of a sticky problem than it was necessarily a few months ago. So it's that number right there, that little orange line versus the brown line, that orange line beginning to tick higher is somewhat problematic. And it's unlikely that you're going to see it kind of go back to the, call it easy 1990 to 2020 type, just straight across, no big deal, flexible inflation, et cetera, goes up and down, but you get the sticky that's fairly consistent. If you look back in the 70s and 80s, there was much more of a flow through from flexible to sticky. That is likely to be at least a little bit what we're going to see over the next 6 to 12 months.
And how about food inflation? I know personally, this is it's a pain point for all of us right now.
Yeah, and it's likely to continue to be that way. The food away from home, that's eating at restaurants, going to bars, that type of deal. That's begun to tick higher, and a lot of that is because it's a lot more expensive to hire somebody in the kitchen, hire somebody to bring the food out, bust the tables, et cetera. So that flows through to the price of a plate of food, right? It's not just the chicken, it's not just the beef, it's everything involved there. So you're beginning to see food away from home tick up, and food at home has been, other than a pretty fast blip in the middle of the COVID pandemic, has been spiking pretty heavily, and that is partially due to supply chain issues, right? We have plenty of beef, we have plenty of chickens, we have plenty of pork, but there's a significant problem in the slaughterhouses in terms of getting them to market. There's simply not enough labor there. That labor was mostly immigration related. We've seen a significant downtick on the immigration front, and that's creating a labor shortage within that complex, and that's not going away anytime soon. It's very difficult to attract labor into that market. It's not a very, glamorous job, and it tends to not pay that well. So that's going to continue to be an issue there. On the food and vegetable front, you saw problems with truckers going in and out of Canada. That created a whole backup in terms of where fruits and vegetables were coming from, going to Canada, coming back, spoilage, et cetera. That's going to continue to flow through the system, and energy isn't going to help much. And that's the next slide that I think is it's this is a little troubling on a number of fronts, that energy tends to lead fertilizer prices, right? So blue line being potash and green line being WTI. If you have persistent problems within the energy complex, you're going to begin to have that flow through to fertilizer prices in the next 6 to 12 months, not in the next 3 to 6. So this is a more, we call it sticky problem, back to the sticky inflation. This is a stickier problem than I think is being realized within some of the markets right now, that when you have a significant uptick within the energy complex, it's going to flow through to food, and it's going to flow through to food in, call it, a crop season from now. And whether or not we have some sort of correction within the energy markets is going to be very important for figuring out what the cost of fertilizer is going to be and what farmers are going to demand for prices in, call it, the fall, winter, and next spring. So this is something that isn't going away in the near term and could become much more of a problem. There's the shipping costs that, yes, that's going to be an energy issue, but this is the problem that flows back through to food, and then you begin to have that much higher inflation for much longer within the food complex.
Let's turn next to the Empire State Manufacturing Index. Are cracks beginning to emerge in the manufacturing boom?
This is a tough one because you saw current orders fall, you saw current activity fall, you saw unfilled orders begin to downtick. That's disconcerting. The manufacturing boom was kind of the tailwind that we were kind of using to get through a lot of the issues that we had coming out of COVID. That you're beginning to see that fall is somewhat problematic. The interesting part about the Empire State Index is that it tends to be a pretty good leading indicator for the PMI, the Purchasing Manufacturers Index, Purchasing Managers Index. That tends to be a very good leading indicator for U.S. growth. And if you're beginning to see cracks here, it's disconcerting for the PMI release. What is likely coming through here is a mixture of two things. One, rising energy costs are not great for manufacturers. That's problematic. The other one that's probably flowing through here is Omicron. What we've seen over the past few weeks is a number of people calling out sick. That's probably creating a labor shortage within the manufacturing complex. And it's likely that you're going to continue to see that happen. This isn't something that you're going to see dissipate quickly. This is bad. When you have orders going negative, that's, call it, a 2-month problem. That's not a 1-month problem. Omicron, if that begins to become less of an issue with workers calling out sick, that will be somewhat of a tailwind. But this is more than likely higher input costs translating to higher pricing that manufacturers are demanding, and lower demand generally. So you're probably beginning to see some demand destruction flow through the system.
Well, Sam, thank you for your thoughts today. And as always, thank you everyone for joining us. If you have any questions on the mentioned topics or suggestions for future episodes, please let us know. For any further information or questions, please contact Gus Handler at gus.handler@arborresearch.com. Have a great day.